have been constructive on the markets all through.
Is it still as exciting? Because, it's even one tick up.
And we get as excited.
It's technically a new high. So.
But Tamanna, 26% in 1 year. That's the sort of returns we've pulled out. And I think that's pretty phenomenal, given that everyone was so circumspect, the markets in the second half of last year.
I think that's the point. I mean, not just India, globally as well.
Yes.
Yesterday or day before yesterday, Morgan Stanley's Wilson saying that there will be a 10% correction and those markets continue high. And so many people sitting on some bits of cash and the market is proving everybody wrong. So I think it's a bit of wait for the market to signal the downside. Until then, preempting or calling the tops is turning out to be futile exercise.
I would say be a naysayer at your own risk. For a pessimist or a glass half empty kind of person right now, it's very difficult to understand what's happening. But I would say that as the party is continuing, keep cheering on, because why not? And that's really the story in the global markets as well. So let's start with how the global market is setting up trade for today. And in the US, of course, it's all about Powell. And you saw that mixed kind of a trade as a result of it. S&P 500, NASDAQ have closed at record highs. And once again, much like what's happening with the Nifty and the Sensex, these are technical record highs because they're inching upwards. The Dow futures now slightly negative. Dow was about 52 points down. But it's all about Powell's speak. So the Fed chairman is presenting his half-yearly report card, so to speak, in front of the government. And this time he was speaking in front of the Banking Senate Committee. Now, one of the statements he made is crucial, and I'll just pull up that particular quote. It's important to contextualize it. He says, reducing policy restraint too late or too little could unduly weaken economic activity and employment. He goes on to say, of course, the usual stuff that Jerome Powell says, that is, I need to see data, that we're trending towards a 2% inflation rate, to cut rates, etc. But all things considered, this is quite a relatively dovish statement coming from Jerome Powell, which would give some kind of confidence that we are heading perhaps for a rate cut in September from the Fed. So that's important. Of course, the market is waiting. No, I think the market is hopeful. But I think, what would seal the deal, Niraj, is the data which comes out over the next 48 hours. And so, important to caveat with that, because you're going to have CPI and PPI data coming out. So, Jerome Powell will always say, I'll watch the data first.
Precisely. I think he's for all the last few meetings, he's just hedged it beautifully that, we need to do this, but we are data dependent. We need to do this, but we are data dependent. Granted, the fact that he said for the first time in many times that economic activity gets impacted. But I don't know, that's whole point about wanting data to show by virtue of what happened in the past when they actually, tinkered with the rates too quickly and then had to backtrack and look, not sound intelligent. Maybe, just maybe, they will be very, very careful. I mean, who knows really? I mean, frankly, I'm just saying that all through he's maintained that he wants to wait on data somehow, very, very staunchly.
But makes sense, right? Makes sense. It's always all about the data. And the fact is that the data has not been half bad. You look at jobs data coming in, unemployment rate data coming in. So if CPI is on track over the next couple of weeks, you could see one big uptick there. Nevertheless, so Powell is the big story. And yes, I think people are waiting to see that data as well, which was why not too much movement in the US markets or on bond yields for that matter. So you had a little bit of movement up and down, not really much else, 4.29% on the 10-year. I would say even crude has not moved dramatically, though if you see on a year-on-year basis, of course, the Brent has jumped up, etc. But it's slow and steady overall. So Brent about $85 mark. And, we are quite obsessive about US data, but Chinese inflation data came out this morning, and important to look at that as well. China's inflation has risen 0.2%, lower than estimates of 0.4%. So it's a mixed morning for Asia. How China is recovering also becomes a very important factor in that big picture. So Shanghai mildly down, Nikkei Hang Seng in the green. Implied open for India is also indicating quite a muted start, to be honest. So look at that there, completely flat as flat can be, as of now at least. But you did have buying come in yesterday, so that 0.5% tick up on the Sensex. The Nifty was, with buying all round. FI is buying again, 314 crores, not massive volumes compared to what we're now used to seeing. DI is about 1,400 odd crores. So that is the setup. But before we get to the trade setup for today, let's also just play out a bit of that soundbite we've been discussing here. What Jerome Powell says when he does come and say that officials are increasingly wary of potential risks to the U.S. labor market from high borrowing costs as they seek more evidence that inflation is slowing down. Listen in.
The most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now, the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
Right. While all that commentary from the Fed has been important, I think critical will be also inflation and IP data for India, which releases on the 11th and 12th. So while we focus on the US and China, India somewhere also finds its presence with data. But Tamanna, you talked about the FI buying. And if you quantify these numbers beyond yesterday and beyond this week, FIs have bought $1.3 billion in early July, and they've added $3.18 billion in the month of June. This has negated any selling that was seen in April and May. So that 26% gain on the index and a 13% rally in the last 1 week. And of course, India has exceeded that $5.5 trillion market cap as well. So a lot of excitement, and it's not completely backed by DIs anymore.
Yeah, that too. And the fact that the FI positioning on the derivative side has been so aggressive post June 4th. I mean, the long short ratio 3 days ago, I haven't checked it recently, but 3 days ago was about 83%, which is quite stunning, really. But there's not too much to add to what Tamanna and Samina have said. Effectively, fresh highs despite overbought levels, essentially showing the difficulty in calling out tops. Almost everybody who's tried to do that and sit on large levels of cash has gotten proven wrong. The interesting thing, though, in trade yesterday was that PSU banks, after some time, saw some concerted buying. Now, you could maybe talk about it on the back of the yields coming off or something else, but therefore yields become a key to watch as well. India yields I'm talking about, and let's see if there is further buying that comes into PSU banks. Remember, private banks are not giving you enough reasons to go and log on them. Can PSU banks do that? Let's wait and watch. But a space which is unanimously seeing buying for the last 3 out of the last 4 sessions is pharmaceuticals. Yesterday too, Nifty Pharma had a very strong day, about 1.5% or thereabouts in trade. But more importantly, Thursday, Friday, Tuesday, we're seeing some serious buying within the pharma names. And the belief is that low valuations plus expectations of a fairly strong Q1 would lead to this happening. But by the way, guys, speaking of Q1, the interesting piece that I thought was Morgan Stanley, which has largely been a bull of what will happen, and they're still bullish on India. But their note on earnings said that the earnings growth will likely decline in Q1 from a high base, even if we are in an earnings up cycle for the 15th straight quarter of double-digit earnings compounding on a 3-year trailing basis. So it'll be interesting to see if Q1 sees a dip and whether people have to readjust their numbers, because a lot of people are saying that if financials earnings give way, it's very difficult for other sectors to come and make up for that by virtue of the weightage that financials have.
But just to build on that, historically, if you look at corrections, they're usually timed around first quarter earnings, which also means that if you're saying what you are saying, that there could be a little bit of disappointment around earnings, that may be that trigger that the markets are waiting to just go out and consolidate, take some profit off the table. But the last 5 or 6 corrections that have come in have been post Q1 earnings. So the next 2 months may be okay, just after earnings, but we should potentially get a dip post that.
For a lot of sectors, it's also traditionally not the strongest quarter, Q1. So, I mean, that to keep in mind. Plus, you have, I don't know, once you have your monsoons in place, clarity from policy direction, and everyone that we've been talking to, they're penciling in, more action in the second half. So Q1 is sort of a holding period in that sense, and perhaps that's what we'll see and what MS is about as well.
Hopefully it holds out.
Yeah, but I think it may just be a morning where you will have a little bit of consolidation emerge. So I don't think a new record high is likely in today's day of trade at least, but it's been a good run. It's been a good run for the street. The Nifty has done exceptionally well in the last 1 year. We've kept up to our global peers in terms of returns for our markets, despite a big event that was the elections in India. Well, 1,200 points have been added to the Nifty in the last 1 month. It's been supported by FI buying that has actually helped our markets. So while most of us were expecting the debt market to see that sort of inflow after India's inclusion in the JP Morgan bond index, it seems like equity has once again scored as the preferred asset class in India for foreign investors. In terms of what we have, Bank Nifty weekly expiry is high today. It was up about 0.3%, but Bank Nifty could be a critical sort of player in today's day of trade as well. Well, we'll go into stocks and tell you what's expected. You've also got a brand new listing today, MCure, trading at a massive premium in the grey market, somewhere in the range of 390 to 400 rupees. It was subscribed 68 times. So a very excited listing is expected later on in the day. So watch out for how well MCure does as it makes its debut on the exchanges. In terms of stocks, earnings season has started. Few companies reported. You have Delta Corp. Once again, a pretty weak quarter for this one. So the revenues were down 30%, profits were down a whopping 68%. There was a time when Delta Corp was a darling of D Street. We've come a long way since then. EBITDA margins have come down pretty much half at 16.9 versus 36.9 that we've seen. And revenue from gaming operations also dropped 33% to report at 169 crores. So this might be one big loser in today's day of trade.
Just on Delta, for quite a few sessions, this stock was revving up without any rhyme or reason. And
it's like a large part of the market.
But Delta, it's very clear what the policy direction is. The government does not want to encourage the business in which Delta Corp is. So I don't see how you fight against that tide at all as a company.
I don't know if you both remember, but I think it was over a decade or maybe 15 years ago when Rakesh Jhunjhunwala identified Delta Corp. And this was such a great story then when casinos were popping up in states like Gujarat, Delhi, Goa. So there was a time when this counter did well, but like you said, the business model has changed, regulation not working in favor of the likes of Delta Corp, the earnings clearly reflecting that. The stock has gained 7%, like Tamanna said, in the last 5 days. But if you do look at the last 6 months return or year-to-date return, it still trades about 6% lower in terms of what we had. Well, another one that shows up on the list, it's become the Cochin shipyard of the Mazgaon docks of this week, and that's RVNL. After weeks and weeks of consolidating, the stock is eking out gains every other day. The stock is up 46% for the month, lost significantly in trade yesterday, but that could just be healthy profit taking. What we have this morning is an Autowind coming to their rescue. They've emerged as the lowest bidder for a 203 crore railway contract from Southeastern Railway. The execution time period is not very long, so that could be viewed positively. That stays at 18 months. They've also signed an MOU with Middle East and Africa to build out to undertake railways work in the MENA region and the European countries. They've also won another order for about 187 crores for the Maharashtra Metro. So it's a bunch of orders and an MOU with the Middle East and Europe, with the MENA region. So that, of course, is going to be a positive trigger for RVNL. Could see an uptick in trade. Havells, quickly going to mention that expansion is on the cards. The management has consistently talked about how they have been aggressively expanding the manufacturing capacity. This time round, adding about 375 crores to add 41.2 kilometers of annual capacity by March 26. So about 375 crores being added to expansion, which will be completed by by March 2026. So that's Havells for you. One more to watch out for in trade today, guys.
First on my list is, I think, one of the top gainers and stars of yesterday, but a lot of notes out today. I'm talking about Maruti. And we're going to have a discussion ahead on what's happening in that entire space with inventory levels building up. But the reason for Maruti to, drive about 7% up yesterday, which is a rare sight, to be honest, in the markets, is a decision by the UP government, which was reported, and actually that decision was long pending, notified on the 5th of July, to waive off registration taxes on hybrid vehicles, and they define them as pure hybrid vehicles. Now, this is a big uptick among listed players. Of course, number one is Maruti with the Grand Vitara and Invitico, two of their models which would benefit from this. I had the opportunity to speak with R.C. Bhargav also yesterday. He talked about how this would definitely increase sales in the entire NCR region and not just in Uttar Pradesh. And of course, the hope is that more states will follow. Maruti also confirmed to us, in fact, and we'll play out that bite for you in a bit, that they are talking to other states and the center to define incentives for hybrid vehicles. Now, Citi today has set a target price of 15,100. I mean, that's a hefty one for a Maruti, up 18%. They say it's the top sector pick. And the biggest trigger, of course, is this UP announcement that I talked about. UP contributes 10% of passenger vehicle sales and 11% of Maruti sales. So it becomes important and could see a further upside to volumes if other states follow, which is really the big reason and the big hope for that 7% uptick. MK is a little circumspect. Of course, they see a positive on the developments, but they've maintained a reduce on Maruti. And they see a target price of 11,200, possibly because of the run-up that we've seen, downside of 13%. They have, though, maintained an ad on M&M and Tata Motors in view of this beneficial hybrid taxation, which is a positive, bringing them at par with EVs. Maruti, of course, is a major beneficiary of the registration fee waiver for hybrids, and West Bengal could also reduce registration on CNG cars. So that's really what we need to look at, that beyond just going on and on about EVs, do we as a policy move, states and center, look at non-EV options against your traditional ICE engines. So Maruti could be a big beneficiary. You could see more up move today. Adani Power was the other one, the second one on my list. It's wholly owned subsidiary. Mahan Energen has entered into a PPA, a power purchase agreement with Reliance Industries. It's a 20-year agreement for 500 megawatts. RIL has acquired a 26% stake in this unit of Mahan Energen's thermal power plant, and it's part of the total capacity of 2,800 megawatts for MEL. That's Mahan Energen. So that's one to watch on. A lot of buzz on Adani Power as well. HG Infrastructure I found interesting. MK has initiated coverage with a buy as well on it. It has some news coming in. It's entered an MOU with Ultra Vibrant Solar Energy for acquiring project development activities worth 465 crores. This company, Ultra Vibrant Solar Energy, has been awarded new solar projects from Jodhpur Vidyut Vitran Nigam Limited. So just for a second, look at the bigger story here as more and more local bodies move towards alternate energy sources. So these kind of deals become important, and HG Infrastructure is one stock and focus on that. That total project size is about 83 megawatts, which will be taken over by HG Infra. So HG Infra is one perhaps you should keep on your radar today.
Yep. Also keep on radar the two block deals. Delivery, which is a clean out trade, of course. So that's one to watch out for, because the stock may actually bounce. Canada Pension Plan Investment Board will sell the remainder of the 3.17% stake. The offer price at 378 to 389. Not a very hefty discount to yesterday's close. So that's to be kept in mind. So Delivery is the first one, and Mankind is the other one. The block deal today. Offer size of 763 crores at a 2% discount to the current market price. Not a hefty discount there either. Again, therefore, may not necessarily be that bad for both of these stocks. The demand might be good, which is why the discounts aren't that great, by the way. So keep that in mind. And there are other stocks, but I thought since brokerages have come out with notes I thought the one by Goldman Sachs on credit access Grameen was one that stood out for me. They have a buy rating with a target price of 1784, which based on the current market price, 1282, about a 30% odd upside. They did a stress test by virtue of the portfolio or the liking that they have for the stock, and apparently the stock came out with flying colors, very limited downside, risk reward attractive. Do watch out in case credit access Grameen reacts positively. It would be on account of this Goldman Sachs note. So keep an eye out for that.
Just a quick one to track, smaller but definitely worth a mention, is also RK Swami. Reported numbers, the company's revenue from operations was up 13% to come in 331 crores in the first quarter of FY25. PAT was also up 27%. So while Delta disappointed hugely, you have the small cap company RK Swami that has actually reported a 27% rise in profits. The other one, again, definitely small company in terms of size, but you also have Diamond Power. They've received a letter of intent from Adani Energy Solutions for an order worth 899 crores for the supply of AL59 conductors. So again, Diamond Power could be one that we will see in trade today. But I think the bigger talking point remains...
Sorry, just one, even Marathon Next Gen, right? In terms of numbers, very disappointing quarter, so might react a bit
It's surprising,
negatively.
right? Because we've seen every other real estate player seen a massive jump in pre-sales. Marathon Next Gen, maybe it's reporting, maybe it's...
Or maybe it doesn't have new launches
inventories
to do the pre-sales, but not a
company's been in
disappointing one.
trouble also for a while. I mean,
So very, very weak numbers in terms of reporting. And remember, it's a 3,000 crore market cap, so small, but it's been a weak one for them at least.
All right, we're talking about autos this morning, and Tushar is joining us, and there's an SUV price war brewing.
Yeah.
Tushar, two interesting announcements last night from Tata Motors and M&M, and nothing more exciting than an SUV price war. Tell us what's happening.
And it's not a coincidence, Tamanna. Good morning, everybody. So we are looking at an inventory of about 2 months, in excess of 2 months. People we spoke with yesterday indicated that the inventory levels in this auto space, car space, is about 65 to 70 days. That's a pre-festive season stocking level that's already being seen 3 months in advance. So we know how much is going to... So it's not a coincidence that Tata Motors and Mahindra both are slashing the SUV prices. So last year, there were no takers for, so to speak, the small cars from Maruti. This year, we are seeing in the last few months, there are no takers for even SUVs.
It's surprising, right? Because India seems to be an SUV market.
Yeah, so we are graduating towards that. About 60% of the volumes are now coming from SUVs, monthly volumes. But that even is now seeing a slowdown. It can be the impact of a high base effect. Also, cars are getting costlier day by day. So there is a slower uptake of cars despite discounts coming in, despite offers coming in at the dealer level. So despite those moves, we are still looking at inventory, and that fits well with the discounts that have been offered by Tata Motors and Mahindra. People we spoke with yesterday also indicate that while this is at the higher level right now, around the 20 lakh mark, both Tata Harrier and Safari are the large SUVs. Both AX7, XUV700 is the large SUV. But that may even actually trickle down to the compact SUV space as well, which almost is, again, within the SUV space is about 50% of the market, which is the 7 to 10 lakh, 7 to 12 lakh bracket. The average selling price of a car right now is about 11 lakhs. So, you know, that's
across all models.
Across models, that's 11 lakhs. Unsold stock is at about 7 lakh plus units in stockyards at this point of time. That translates to about 70,000 crores of unsold stock lying with dealers.
Tushar, just for perspective, when you talk about 2 months inventory, so that how higher is that from what is the typical inventory build-up? Is this an unusually high inventory build-up number? Is it average? Just give us that, relative perspective.
Yeah. So essentially, dealers are comfortable with anything which is a little over a month, so that they can offload it as far as demand comes in. This is not natural. This is extraordinary, so to say, because this is the levels that we see before the festive season. That is in the month of September, at the end of September. Because you remember, dealers are stocking up for the extra demand that comes in during the festive season months, which OEMs may not be able to provide with their production volumes or dispatches in the month of October and November. So those levels are being seen now. 65 to 70 days inventory levels is what we see at the end of September, not in the month of May or June. So this is the reason why the inventory is a big concern at this point of time.
Wow. Okay. Well, let's get in a voice on this, external voice on this as well. Venkesh Gulati, Chairman at FADA Academy and Research, joins in. Mr. Gulati, good having you. Thanks for joining in. Do you find, or let's say 3 months ago, if you were told that the inventory levels on the SUVs would be about 2 months or 70 days, would that have caught you by surprise, or was this anticipated?
Obviously, anytime it is a 2 months inventory, it will be caught by surprise because it's not a regular affair. So like Tushar very rightly said, a pre-festive preparation of 60 days or 70 days is what a dealer wants to have and a manufacturer wants us to have. And we are happy to have at that time. But if you talk about N minus 3 months or 4 months, that's not what we look at any period of an year. So practically it starts, what happens is like 35 days is what inventory we look at. And if the festive is in October, so July is around 5-10% take, and then August 20%, and September reaches the level when we say that it's 60 days inventory. So it slowly crops up in 3 months time, which this period has come up very, very early. We were expecting not such high inventory. We were expecting that because of not having marriage season this May and June, it will be a challenging thing and inventory will go up to around 40-45 days. But coming at 70 odd days was not an expectation, and more than a surprise, it's a very, very big challenge and a concern for dealer fraternity.
Venkesh, hi, good morning. Tamanna here. Just trying to understand if you expect this price war to extend. We've seen two players and the expectation is it goes into the compact SUV. Do you see that happening? What is your sense?
I'll not say this is a price war. Obviously, this is a reaction to one UP hybrid thing also. This is a reaction to some models which were high in stock in dealers' inventory and not selling. So if you see XUV 700, even till today, AX5 is in shortage. The customers are waiting, but AX7 is in demand. So somewhere the price matching was not there, which Mahindra has done for. Even Tata has done only for two products, which are very low in demand at theirs, and the dealers are having even more than 70 days inventory of those specific models. But yes, I feel this is the reaction of high inventory what OEMs have started now giving. So by even in August, I feel you'll see everybody coming into giving schemes to liquidate stocks, because such high stocks carrying for a month or two is still, I'll not say viable, it's still manageable by a dealer, but it goes up to 4 months because it started from May. May was bad, we reached around 50-55. June and we reached around 70. So this is already started a month back, and a dealer can't continue carrying such high stocks at such wafer thin margins what we have when we sell the vehicles. So automatically to liquidate this stock, all the OEMs will have to come down to the market and increase these schemes and all that. These two was price cut, but you will see major schemes coming in, major discounts coming in from the manufacturer and the dealers too, to liquidate these exact variant which is more in stock as comparative to other variants.
Mr. Gulati, Tushar here. Good morning.
So, Tushar,
good morning, sir. So, what is the way out of it? We are seeing the inventory build up. Do you think the OEMs should reconsider their production schedules so to bring down the inventory levels at the dealership level? We are seeing the mismatch already. I mean, dispatches were higher by about 2% last month, but retails were down by about 8%. So 10% gap in just 1 month. So do you think do car makers need to realign their production cycles, so to speak?
So Tushar, basically it's law of economy. If the demand is not there, you will have to reduce the supply. But if a manufacturer thinks by reducing the supply, the cost, or you can see the efficiency loss what they are having is not matching, they continue to not reduce the supplies and push the inventory towards dealer. And when such a situation happens, they have to again support us from somewhere, interest or rotation of funds, and then in turn, even discounts to the customer. I feel the best thing to do is, as per demand, the supply should be retuned. I don't know why the manufacturers are not working in that. And practically, like you said, the high base. If you remember, the last year we were doing around 3.2 to 3.5 production. This year, that production capacity has increased to 4 lakh and more. There are many manufacturers who are still increasing their production. I feel the only way out, because still we are sitting in July and the festive is in October. We're talking of 3 months more going. Unless and until OEMs reduce their production level or the capacity, or they go out so much so that the demand increases like festive for the coming 2 months, which I doubt will happen. These are the only two ways. They have to improve demand or reduce supplies. Or else what will happen? The supply chain at the dealers will choke, and in turn it will affect the market.
All right. Thank you so much, sir.
All right. Vinkesh Gulati there talking about the dealer side of it. And, to be fair, Tushar, the dealers always have this slightly, negative view, because they're the ones who are stuck with the inventory and feel the heat.
But at this point of time, it's also extraordinary circumstances. You're not looking at 2 months of inventory in the month of June. That's in a way that their worries are also warranted, so to speak. You do not want to be saddled with 70,000 crore of...
But it's also specific. So, see, what we are doing is we are relating this to the price cuts yesterday. They're two disparate items, which we are, of course, seeing in conjunction. But one important clarification from Vinkesh is it is on models that are not doing too well.
Yeah.
So it's a mix of things. You're trying to push out stock, which is part of, normal course of things. But I think also the fact that it's linked to what has happened in UP yesterday, and I just want to run a clip of a conversation I had yesterday exclusively with RC Bhargav after this order. And I think the big takeaway is that the industry, at least the domestic industry, is hoping that policy-wise there is also as much a push on hybrid vehicles instead of just EVs, and UP's decision could be the first step in that direction. Listen in.
Everybody in the country wants two things. One is that the pollution level, the greenhouse gases which create the global warming should be reduced, and we should meet our zero carbon credit. The second is that our dependence on foreign imported oil must be ended or at least minimized to the extent possible. And the policy of electric vehicles was brought in for both these objectives. But it has been realized that while electric vehicles are gradually getting into the customers' buying package, there are large amount of ICE, petrol and diesel vehicles which are being bought also. And they continue to pollute and they continue to consume oil. So if we want to achieve the objectives of reducing pollution and greenhouse gases and use of petrol, we must use other technologies in addition to electric vehicles to bring down the pollution from pure ICE vehicles. And the use of hybrid vehicles, the use of CNG, the use of biofuels are all means to do that. So I think the UP government has been, very proactive, very smart, and I think very commendable that they have realized that if the country is going to achieve its objectives of 70 and before that reducing imports, then it is necessary to encourage technologies other than only electric cars, because electric cars alone will not do the job. And that is the outcome of that realization is this policy.
Are you in conversation with any states or the central government to have a more permanent sort of relief for customers to choose hybrid vehicles? Because today the fact is it costs me more if I want to go hybrid.
We have been saying this for a long time that all technologies which are cleaner must be encouraged.
Okay. Yes, sir.
So I'm saying we're continuing to discuss this with the central government, with some of the state governments, that there is an alternative route than just pure electric to get to our goals, and that we must all look at what is practical and what will lead us of cleaner India faster.
Welcome back. This is India Market Open. We're taking stock of the futures and options space at the moment. And yesterday we had another milestone day where the Nifty made another lifetime high, moving and closing above the mark of 24,400. And along with that, we actually, in fact, did see a little bit more longs as far as the futures are concerned as well. So let's start by taking a look at that. And at the moment, while we do see longs there as far as the Nifty is concerned, the Bank Nifty, of course, on the other hand, did take a step back, and that's where we saw a little bit of unwinding coming through. Now, that said, when it comes to the options market on the Nifty, at the moment, we're starting to see a little bit more strengthening of levels slightly higher than the 24,000 mark, with puts being written at 24,100 and 200 levels as well. And on the higher end, we haven't seen as much traction around the 24,500 calls, naturally because we're not too far away from that mark, but still increasing amount of rights calls being written around 24,800 through 25,000. As we move into the Bank Nifty, well, we are keeping an eye on the expiry. I reckon the 53,000 mark will be an important one, considering we've seen a little bit of strength as far as the index is concerned yesterday. But moving on to stocks, again, keeping an eye on something like Grasim, Balrampur Chini and Exide, which in fact did see longs coming through. Among stocks which saw unwinding, we did see short covering for Hindustan Copper. Aisha Motors, as well as HDFC Life. Malik on Chambal Fertilizer, looking at some shorts. Chambal Fertilizers particularly stands out in trade. But let's take a look as to what our experts have to make of these markets and how they're playing them. Well, we have Ajit Rambia of Ajira Ventures who's joining us on the show. Ajit, good morning. Thank you so much for joining in. I believe that you are looking to play the Bank Nifty. Can you take us through this specific, option structure here?
Yeah, good morning, Alam. Thanks for having me on the show. So in Bank Nifty, last week it was like the current sideways movement in Bank Nifty. We can initiate a short straddle in 0DT, today's Bank Nifty's expiry. So we can sell 52,500 calls and puts. So 52,500 call is placed at 235 and 50,000 put is placed at 184. So we can place our stop loss on both individual legs at 60% higher than the price sold. So on the call side, we should place a stop loss of 376, and on the put side, we should place a stop loss of 294. So if any of the stop loss price figures, we keep the other leg intact to earn complete premium at expiry. Here the total premium to be gained is 419. So if it closes at 52,500 at the market closing, we earn the complete 419.
Okay, interesting. So we have an intraday strategy here for the Bank Nifty, and as Ajit has put that while you don't necessarily have legs at the moment, what he's looking to do is in fact keep a rupee stop loss at 60% of the premium that you paid for each of these strikes, and based on that, if you do in fact see one of these strikes get hit, you can keep the other strike intact, and that could eventually likely yield to something, if not anything at all. And I reckon so it's a short straddle, and it is on an intraday basis based on today's expiry. That said, Ajit, can we move on and talk about Hindustan Copper as well? If I'm not mistaken, you have a view here too.
Hindustan Copper is coming out of FNO ban today. It was in ban since last many days. We have a bullish stance on Hindustan Copper. So we initiate a simple bull call spread where we buy one ATM call of 350 at 12 rupees 65 paise and sell one OTM call of 400 at 2 rupees. So here the cost of the strategy is mere 10 rupees to earn a potential profit of rupees 40.
Okay, there you have it. So a bull call spread, a simple, straightforward strategy on Hindustan Copper. And again, it does seem like the risk-reward ratio in this case seems favorable. And it's perhaps a better, bet to place as compared to going long on the futures, considering there is a limited downside to a bull call spread in this case. But Ajit, on that note, taking a moment to thank you for joining us and taking us through your views in the markets, and of course, handing us a couple of option structures to work around with. With that, it's over to you, Samina.
Thank you for that, Agam. That, of course, is a quick take on the FNO space. It's the bank weekly expiry, so that space of the market will remain fairly volatile in today's session. Well, implied Nifty is indicating to a flat start, so don't expect too much euphoria in the early minutes of trade. In fact, today could be a morning where you may see the markets taking a break after another record high being made on the street. Kush Bora, founder at kushbora.com, joins in with his top recommendations. Kush, first up, it's bank weekly expiry and the Nifty. A quick view on both those indexes.
Sure. Hi, Samina. First up, a very good morning to you. Thankfully, given the SIP and the DII numbers, the situation for the Indian markets is not so gambhir as it is for the Indian cricket team. That said, we are looking at incremental gains on the Nifty, Bank Nifty taking support at that 52, 200, 51, 800 zone and attempting a rebound. My bias for the day from the near-term perspective will remain, a little sideways. Mildly bullish, but if you see, the calls have actually seen a heavy bit of writing. So the upsides even for the day might actually be a little capped. But then again, this market just refuses to go down. So the best way would be to play. This would be any kind of dips that you get should be taken as a buying opportunity. As far as levels go, the support for the Nifty comes in at 24,100, 24,600 will act as a bit of a resistance. On the upside for the Bank Nifty, we're looking at a 53,300. The support for Bank Nifty, as I said, 51,800, 52,200 continues to remain as a base.
Sure. In terms of top stock recommendations, before we go on to discussing the big movers yesterday.
Sure, Samina. Before I move on to the recommendations, just an update. We discussed Welspun Corp and AMI Organics 2 days ago in the morning show. While AMI came very close to its target one, it did not really hit that and then went on to hit the stop loss. But Welspun Corp, on the other hand, went on and, is up about 7%, way above our second target as well. So if someone's still holding it, I think it's a good idea to exit both of them. Now, coming to the stocks for the day, pharma space has seen a lot of traction. So, one of the picks has to be from this space. Torrent Pharma, for the last few sessions, has actually been doing rather well, broken above that 2,900 mark. So from a near-term perspective, 3,075, this remains a good target. 2,875 is where you want to place your stop loss. PI Industries, this is the other stock, fairly volatile, but if you see there's there's a very clear delivery markup that's happening. That's seeing a pickup on PI Industries. I'm sorry. So from a near-term perspective, the targets for PI Industries are 39.50 and 40.50. A stop loss for this one comes in at 37.50.
Okay. Well, Kush, firstly, thank you for giving the update on the previous calls as well. A good thing, but the interesting thing about Kush's picks, viewers, also shows the point that there is buying that is happening in pharmaceuticals, buying that's happening in select chemical names, and those are the pockets to monitor very, very closely. The other thing, Kush, that I want to check is autos. And because auto was such a big mover yesterday, however, there is fundamental reason, inventory buildup, etc., which might lead to some of these stocks cooling off too. So I don't want to get into two-wheelers. If I stick to four-wheelers and the three names there, Maruti, M&M and Tata Motors, what do the charts suggest?
Hi, Niraj. First up, a very good morning to you too. Very different setups for all three of them. Let me start with Maruti, the big mover for yesterday. During the close of the show, and this was a discussion we had, that 13,000, 13,200 might be a near-term resistance. Has been for the last 3 to 4 months. The call writing also suggests that the upside here could be a little limited. So if I were playing Maruti, I would perhaps take some money home, book profits. Even if it moves another 300 to 400 points from here, the risk-reward ratio is not really as favorable. So for me, a Maruti, after the move that it made yesterday, it was a prime short covering candidate, but then all of it came in a day. So I would, take some money home. I won't enter afresh in Maruti from a near-term trading perspective. Mahindra and Mahindra, on the other hand, is consolidating beautifully around the 20-day moving average mark. The volumes are thinning. The momentum is attempting a pickup. But right now, for me, Mahindra and Mahindra is a very clear positional bet. Typically this stock has a tendency of forming a base for about a couple of weeks and then shooting higher. We've seen that activity happening, might continue for some time. So from a near-term perspective, this 2850 level is a very strong one. So if someone's looking for a positional bet, that's where you enter Mahindra, hold it for 2 months, maybe 3, and you can look at upsides well beyond 3050, 3100 levels also. The only stock that makes sense from a near-term trading perspective is actually Tata Motors. The correction is over. The base formation is over. We've had a golden crossover. The momentum is also picking up. And, the 1,000 resistance level being taken out, for 2 days, it's been above that level. So here you could look at a 1040, 1070 kind of targets. And the stop loss here comes in at 980. So as I said, very different setups for all three of them. From a momentum perspective, you could look at Tata Motors and Mahindra from a positional standpoint.
All right, Mayuresh also joining in. Very good morning, Mayuresh. Great to speak with you today. Now, here's the conundrum. We are making new lifetime highs every day. Clearly, the trajectory is same. But the momentum has dwindled a bit. I just want to take off from what the Morgan Stanley note said today, and it was a little circumspect about what the Q1 numbers would look like. So let me start with your take on that.
Morning, Tamanna. Absolutely right. I think earnings is something which is going to now decide the direction of the market. Obviously, we've got a budget to comprehend with over the next couple of weeks. But once the budget is largely over, the markets will revert back to mean. Now, it's interesting. I was reading a Motilal note, and that note probably suggests that over the last few years, the earnings growth has probably mirrored the kind of growth that you probably seen in market cap. So, to that extent, historically, earnings have probably delivered, specifically in the post-COVID era in the last 2 years. Now, we probably got a very high base that a lot of corporates need to comprehend with as we head into the next 2 financial years. Now, the market is of the opinion that earnings growth will continue in the range of 12 to 14% as a base case scenario. And therefore, I think a lot of companies probably need to meet this criteria if they want to maintain the premium valuation that they are probably getting at this juncture. Certain sectors might actually adhere to this earnings growth. Some sectors might not probably get that number. And therefore, it's going to be a mixed bag as far as earnings are concerned. Q1 will probably give you a clue. You're absolutely right, Tamanna, in terms of how these sectors are probably poised, not just for the first half, but on an annualized basis as well. And therefore, our take is that domestic cyclicals might still continue doing well. You might see a revival in terms of both consumer discretionary and staples as we head into the second half, if monsoons are the way it is expected to be, a normal monsoon this time.
No, absolutely. Let's get specific. Some stocks to keep an eye on heading into today's trade. And Anushi joins in with more details. Anushi, what's on top of your list?
Right, morning Tamanna. So the top one on my list is delivery. Now a block deal is going to happen here in which Canada Pension Plan Investment Board is planning to sell their remaining 3.17% stake. So with this, they'll be completely exiting delivery. Do note that they had bought an 8% stake in delivery in 2019 and held about 6% stake in delivery since IPO till March 24. After that, we saw it paring down the stake in April of 24. And if you look at its last updated data as of March 24, they had about 5.96% stake. So now this offer price range for the same was at 378 to 389, which was at a 0.7 to 3.5% of discount compared to yesterday's close. So with this block deal, the Canada Pension Investment Board the offer size comes up to about 886 crore. Now moving on to RVNL, a bunch of updates on this one. Firstly, it has emerged as the lowest bidder for 203 crore of railway contract from Southeastern Railways, and the execution time period for the same is about 18 months. Along with this, they have also signed a MOU with Tatweer Middle East and Africa. This is for rail-based works in the Middle East and North African regions. Along with this, there's another update coming in from this one, wherein they've received a project worth rupees 187 crore from Maharashtra Metro Rail Corp. This would be for construction of about 6 elevated metro stations in Nagpur, and the execution time period for this is about 30 months. So if you look at RVNL in general, the stock has rallied up about 30% in past 1 week. Even if we see its order book guidance, they are expecting an order book of about 1 lakh crore at the end of FY25. So more order inflows and more orders remains in focus for RVNL. Last one on the list is HG Infrastructure. So yesterday we discussed about how HG Infra had entered into MOU with Ultra Vibrant Solar Energy. So now we've got the project number as to how the value of the project it has received from the same. So it will be acquiring project development activities worth about 465 crores. So this includes a project of Ultra Vibrant Solar Energy, which was awarded from Jodhpur Vidyut Nigam Limited, and this is a project size of about 83 megawatts, which will now be taken over by HG Infra. So these are the handful of stocks that will remain in focus today.
All right, thank you for that, Anushi. Kush, let's come to you for some of those stocks. We won't talk about RVNL. We'll try it. I don't know how we'll avoid talking about RVNL. It just makes sure it's in the news one way or the other. But let's also address HG Infra and delivery.
Well, I think as much you've spoken about RVNL is just about as much attention it deserves in trading right now.
That's true.
So I think
that's true.
I'll park that one. See, as far as HG Infra goes, we've had this on our radar. It hasn't really translated into a trading call because of the volatility that we see in the stock. The stock has a tendency to move as much as 25-30%, and then perhaps go into a smallish consolidation zone with a negative bias. So that's again the pattern that we're seeing here. So while I remain constructive, on HG Infra, it just becomes a bit of a patient kind of a trade. So if someone is looking at entering, then 1650, 1600 should perhaps be a good zone where you should place your stop loss from the current levels. 1850, perhaps even 2000 also as a positional target. So for me, HG Infra is more of a positional play. The other one was delivery. Now here what we've seen is that the stocks actually shot up and consolidating with a heavy negative bias. For me, this is actually perhaps an exit kind of a stock. 380 very strong levels. If those get broken, then I would actually perhaps exit this and wait on the sideline. So delivery, a negative view. 380 should be your stop loss from where you exit. HG Infra from a positional standpoint should be on your radar with a 1650 stop loss.
A clean out trade, Mayuresh, for a delivery. Now we know that logistics is the big theme. There's a lot of talk around this, doing this. There is a Mahindra Logistics, there is a delivery, there are a few others. Is this a space worth looking at, in delivery in particular, now that the supply overhang may be out of the way?
Morning, Niraj. No, I think logistics is one space where I think the government intent is going to be very, very focused as far as the budget dynamics are concerned. And the logistic infrastructure is something that the government is very keen on in terms of both the completing and ensuring that it fructifies in terms of lesser costs as far as freight movement is concerned. Having said that, a couple of stocks that are on our watch list, Gateway Distriparks is something that investors should probably keep on their radar. I think the biggest trigger, Niraj, here is the completion of the dedicated Western Freight Corridor. A couple of sections are still pending. The expectation in terms of timelines are largely over the next couple of quarters. This should largely be done with, and it should be completely functional. Now, since they operate out of the Western region itself with the dedicated container freight stations, and they've got a good presence in terms of CFS, even on the eastern ports. The expectation here is that volume growth should start picking up quite significantly as far as the gateway is concerned. It's offshoot at the same time, Snowman Logistics. My own take is that there will be a lot of emphasis that is laid in terms of cold chain logistics. Snowman probably is one of the market leaders as far as the organized players are concerned. They have increased their pellet capacity in Northeast India recently. They're doing that with a very asset-light mode, which probably means that they are not incurring a huge capex and leverage on their balance sheet as well. The management sounds very, very optimistic in terms of a double-digit volume growth, expanded margins, and therefore the infrastructure that they probably possess, with some announcements, if any, coming through the budget as well, can also propel kind of a growth that one looks at. So interesting space. I think a couple of stocks that are on the radar of Snowman in Nigeria.
Okay. Mayuresh, thanks for that. Stay on, gentlemen. Both of you will take a quick break, come back and talk about some of the more active stocks as well. We've discussed autos with Kush, but there's lots more that was very active yesterday, and we'll try and talk about some of those, including the newsmakers for today. Stay tuned. We'll be right back.
back. You're watching India Market Open. Are we going to have another range-bound day which ends up with a new high but not too much movement? That's what we're looking at. What would be your top strategy for the day? What should be your top strategy for the day? Kush Bora and Mayuresh Joshi joining us in. Kush, let's talk about a space that you spoke about auto, but let's talk about auto ancillary as well. I think that's one space which could be now in focus with a lot of movement on, and auto already stretched. Is there anything that you would mark out in that space?
In fact, just yesterday in the closing show, we discussed JBM Auto, where it looks, pretty solid. Even in the close, if you see, there was a high delivery pickup that happened. So the stock's actually been gaining for the last couple of sessions. So, we like JBM Auto. Again, from a near-term perspective, 2350, 2400 are the levels to watch for on the upside, 2220 on the downside. But, one stock that remains, our favorite in this space is Lumax Auto. This stock's already run up quite a bit, but not too high, not too fast to create any kind of discomfort. Plus, there's been this profit booking round that we've seen in the last 10-15 odd sessions. So this is a good entry point for someone who would have missed out on the last time around. So Lumax Auto, I would suggest from a positional standpoint, have your stop loss at 550. On the upside, you could look at 600, even 630 as your target. So Lumax Auto is a stock that you should consider as a positional bet in your portfolio.
All right, first rates have hit, and markets have actually opened in the first minute or so quite strong. We'll wait for all of that to settle. Divi's Lab in focus this morning, Adani Ports in focus this morning, both up about 1.5%. Apollo Hospitals as well. Just want to pull up Maruti once again and see what's happening there. Close to 1% up, so still up in the green after all of the action yesterday as well. Nestle, ITC still remain in the green, and that perhaps Tata Consumer as well. So your entire consumption basket is perhaps one theme that you see continuing for some time. Citi note on it out as well today, saying that the key point to watch in the commentary which will come from managements now is what is the extent of that rural recovery? Can we just keep saying rural recovery in broad terms, or do we actually understand how it's translating into profitability or margin gains for some of these companies? And let me just get a quick word from Mayuresh on that point when we're talking about the consumption space, Mayuresh. Which are the companies that can really fly on this theme?
Tamanna, I think FMCG becomes a backbone, right? And rural consumption becomes a key factor for FMCG companies. And yes, we have been hearing of a rural recovery coming through. But I think a genuine recovery will only come through in terms of how monsoons play out, because you've clearly seen sluggishness in terms of rural discretionary spending. As monsoons progress and as the crop output becomes relatively better this Kharif season, the second half of this year is going to be relatively better as far as volumes and value are concerned. I think a lot of companies within this space are probably hinting at the same, where volume recovery and value recovery should start taking place in the second half itself. So yes, I think a few of the FMCG companies where updates have been reasonably enough, Dabur, Marico, Godrej as an example, can be something that can be on your watch list. Again, the QSR plays is something that I'll also watch out for. Because they have hardly done anything in the last couple of quarters. Obviously, they've gone through a periodicity of pain as far as core numbers are concerned. Food costs obviously have inched a tad bit higher this time around as well. You've seen milk prices, cheese prices actually go up. So how do they tackle that in the next quarter or two is something that is going to be very, very interesting. This is one space that I'll also keep on measuring.
What would be your top pick in the QSR space, Mayuresh?
So Devyani is something that I watch out for. But both Devyani and Westlife, I think the kind of innovations that both these companies are probably doing, both in terms of their products, both in terms of their menu offerings, is something that is worth taking note of. The second aspect here, Tamanna, also is that all these companies are taking a very asset-light mode in expanding in tier 2, tier 3 cities. So they're actually going through a franchisee route in terms of establishing their outlets, which means that they're having minimal capex needs as far as their overall distribution reach is concerned. And as we are seeing these trends come out, as more and more eating out trends are happening, even in tier 2, tier 3 cities, over a periodicity of time, the expectation largely is that volume growth should also start getting reflected in the overall SSG growth that these companies might look at. So these two companies probably should be out.
Okay. Well, watching out for what's moving in the first few minutes. Swan Energy, by the way, is really having a great move the last few days. 5% up in the session today as well. GMDC is reacting to that capex allowance. That stock is the third best performer in the first 4 minutes of trade. And Mankind Pharma seems to have digested the block deal numbers well, or block deal well, because the deal has happened. The stock is up about 2.5%, 2160 and counting for this one. MGL, by the way, popping all over the place, so keep that in mind. But Mayuresh, very quickly, Mankind Pharma, before I get to my colleague Harsh for the top brokerage note of the day. Mankind Pharma, block deal out of the way. Do you like the business?
Stable business, Niraj, and clear disclaimer, we hold the stock in our global portfolios. Now, what we do after this is going to be very interesting. The deal is probably done and dusted with. But in terms of their core portfolio, what are the kind of innovations that the management is expected to bring about in the next few quarters is going to be very, very interesting. The management probably in the last few quarters have sounded that they are going to do something which is going to be innovative as far as the markets are concerned. So let's see what the innovative part is and how that affects our numbers in the quarters to come. We hold the stock in our portfolios. So yeah, I think a little bit biased on this one.
Okay, what are the top brokerage calls that you should keep in mind this morning, just a few minutes before we open up for trade? Let's get Harsh in with that selection in place. Yes, Harsh?
Well, it's Goldman Sachs on credit access today morning. Tamanna, you're seeing largely some stress in MFI. The impact of that essentially is that Goldman Sachs has written this note suggesting that the impact will largely be at 3.6% in terms of credit cost. If the 30 DPD were to inch higher basis past numbers and past cycles essentially, and therefore they believe the impact is extremely limited. That's what they are clearly highlighting. They've suggested that the ROA containment should not fall below 4.2% in their base case, and ROE of almost 17% should get clocked even in the base case scenario. In fact, credit cost at 3.4%, ROA at 4.2% and ROE of 17% would largely be a downside risk of 16% on the stock. And given the way in which markets have moved, likely you need to keep that in mind as well. Just in terms of upside, they believe that downside largely limited. Upside, they are expecting, if all of management commentary were to play out, ROAs of 5.4%, ROE of 23%, and a PAT compounding FY 24 to 27 of 23% as well. And therefore, a very strong upside, 36% upside from here, if at all that were to play out. So positive, bullish on credit access despite all the MFI issues which are currently marring the lending industry.
Well, watch out. 2% higher for credit access. Grameen hasn't had the best of runs in the recent past. Can it do more? Harsh, thanks for that firstly. And Kush, coming on credit access, Grameen has a bit of a support right now. 2% higher at the end of the pre-open session. Can it do more?
Well, not so encouraging. As you rightly put it, it did take support at that 1280 kind of mark, which it held on to for most part of the last year and a half. But beyond that, I think 1400, 1380 will perhaps turn out to be a stiff resistance. There's a lot of selling overhang. So any kind of trade on the positive side should be considered once this 1400 level is taken out. So for me, this is still a wait and watch kind of a setup.
Wait and watch credit access, Grameen. Speaking of brokerage notes, there is also Jefferies note on Supreme, if I'm not wrong. 2 days ago, they came out with a note. Also, 2 or 3 days ago, maybe, also came out with a note on Astral and Prince Pipes, if I'm not wrong. But look at Supreme. That stock is up about 3.5% in trade today. Astral has made a move already. Prince too, I think, has made a move. But it's Supreme, which is in focus in the session today. Mayuresh, everybody's taking the P multiples higher for some of these businesses. Jefferies in particular, but other brokerages as well. Valuing Supreme, for example, at 45 times now is Jefferies. Are you constructive on the piping companies? And if so, which one do you like the most and why?
To remain constructive, because I think the entire government program in terms of the outlay of pipes, whether it's Nal Se Jal Yojana, which has a 70,000 crore allocation at this juncture, or the expectation in terms of increasing the gas infrastructure pipeline network from 6% as a consumption to 15%. So there is going to be a huge incremental demand as far as PVC pipes are concerned, CPVC pipes are concerned, ERW pipes, seamless pipes. I think the whole gamut of the piping space are going to see incremental orders come through. Having said that, I think the value additions that Astral is probably making and the backward integration that it probably has is something that is noteworthy of. Supreme as an example as well, Niraj, they've clocked 10,000 crores for the last financial year, and a profitability of 1,000 odd crores. They have a very impressive volume as far as their polymer sales are concerned. In terms of expectations of all their product lines, including PVC pipes, CPVC, HDPE pipes, water tanks, they're probably there in terms of how the top line and bottom line growth is probably moving in. ROEs are probably very, very stable at this juncture. The debt equity ratios very, very manageable, in fact, debt free onto the balance sheet as well, on a net debt basis as well, which means significant volume growth can be expected. To come to your question in terms of how valuation has stacked up, obviously they're very, very expensive at this juncture. The higher multiples can only be justified if they can expect their earnings to compound at a faster pace than industry. And probably a couple of these players can do that. But let's see how Q1 numbers go. So at this moment, I think it's a hold for anybody who's doing this.
Okay. So that's on some of the piping names. By the way, Supreme is not cheap. Keep that in mind. The reason why it is up today, aside of the Jeffries note, of course, but the fact that they are raising the target multiple to 45 times, and that is something that should make a few people think about. Okay, what else? Kush, not a stock that too many people can maybe buy into very easily. But I would love to know, what do the charts indicate for a Swan Energy? It's had a brilliant run, has been up more days than down. Not a very liquid stock necessarily, not something that too many people understand the business very easily. But what do the charts suggest?
Well, the setup's turned very encouraging. It was on our radar about 2 days ago, and thereafter, was a little difficult to get a hold of, with the upper circuits. But even now, if you see, the momentum's actually on its side. The volumes for the last 2 days, perhaps because of the circuit, haven't really been all that great. But I think the overall setup is quite positive on the daily charts, on the weekly setup. So I think from a near-term perspective, the recent highs that it had made, which is close to 770. Perhaps are a very fair target on this one. If you do get an entry today, not a bad idea. You should you could perhaps consider buying 770. As I said, will be your near-term first target. Now, yesterday's closing, which is close to 725 kind of level, should act as your support zone. So a longish period of consolidation, about 3-4 months, but a very clear breakout now. 770 being the first target. Second, you could aim for 795 as well. If you have existing positions, hold on. If you don't, you can enter afresh with a stop loss of 725.
All right, we parked a conversation on this stock for a little later, and it doesn't stop surprising. I'm talking about Rail Vikas Nigam. Block deal also in the stock in pre-market trade, and remember there was a whole host of order wins which were fueling the news. Remember, stock was down 4.5% yesterday after some profit booking, 3% up in pre-market. Kush, let's start with your views.
On RVNL?
Yeah.
Well, same as as they were about 15 minutes ago, which is they've run up quite a bit. If you have an existing position, hold. Fresh entry not warranted at this stage.
So RVNL, Mayuresh, you would stay away right now. Would you book profits or would you just sit tight?
I would listen to Kush's advice. I think very safe.
All right. Let's be careful with a stock which shows no signs of abating. Just to give you a sense of how the pre-market is shaping up, Vijaya Diagnostics has had an interesting up move, up about 4% in pre-open session. Of course, we're less than about 50 seconds, to the session opening up for today. Credit Access Grameen, which we talked about, Goldman Sachs report, also up about 2%. So these are some of the broader market and smaller stocks that are moving today. On the key indices, though, are you going to expect to see any big action? Probably not, I would reckon, Niraj. On a day where it is a bit of a wait and watch, isn't it?
Yeah, Jerome Powell's testimony is out of the way, but lots more lined up, including key numbers that's start to trickle in this week. Remember, tomorrow is the big one from the IT stable, which is TCS. So keep that in mind as well. 15 seconds left. We'll take in some opening thoughts from our guest in a bit, but suffice to say that it'll be a very bottom-up, very stock-specific market today at the start, and not something which will be very, very brisk, if you will. Quite unlike yesterday, we'll not have a Maruti which is trading up about 5% or 4% on open. Flat as flat can be. Flat as a pancake, as the term goes so many times in cricket analogy for a flat pitch. Bring up the Nifty Bank about 1/3% lower, so this one continues to sulk. Mid caps and small caps should come up on your screen next. Do they have some bit of spunk, much like yesterday? Yes, they do. Mid caps are 1/3%, small caps, is it more? About 1/3%. Let's get the heat map up on the screen and show you what's moving and what's not. Okay, wow. M&M on that price cut, down 5.5%. This is a large gash. I don't think we've seen such a large gash on Mahindra & Mahindra in a really long time. It's a stock that's delivered nearly 80% returns in the last 1 year. But this is a sharp gash on M&M. Because remember, for M&M, it is the SUV portfolio which has driven the stock so much by virtue of its success. Is the market reading too much? That's the other question. We'll ask Mayuresh about this. But this is the story of the morning. Nothing else. There is Grasim up. Maruti continues to move higher, another 1.5% higher. Strength in Adani Ports and ONGC again, Britannia again, Titan again. More green than red, but M&M stands out as a stock which should be spoken about. But I must say, yes, on the losing side. But Maruti, having done 6.5% yesterday, has now added nearly 1.5% today. That's really strong as well. So, two conflicting stories. Hitherto SUVs have worked, small cars haven't. Is the small car champion by virtue of the hybrid SUVs making a comeback into portfolios at the expense of the SUV champion? Is the key question on morning on the Nifty, Tamanna.
I reckon the hybrid part of the question is the big one as well, Niraj, not just the price cuts, because is M&M's hybrid portfolio as ready as Maruti's? And if there are any concessions right now from any states, would M&M be ready for it? Well, perhaps not. Those losses receding a bit, just down about 4%, but no doubt M&M is the big cut of the day. Let's look at what's happening in the broader markets, even as indices have been flat. As a dosa, I would say. I would prefer Niraj's pancake analogy. A bit like a dosa. The Nifty mid-cap 150 as well. Let's pull up the small cap as well. No big action on the indices as well itself. Just Bank Nifty very quickly. I want to see what the Bank Nifty is doing this morning and whether it's showing any big moves in negative territory. Down nearly 0.5% really. So banks are feeling the heat. Specific stocks that we're looking at. Let's talk about RVNL. There's been a block deal this morning. It's got an LOA for Maharashtra Metro Rail Corporation project. So it's going to make elevated metro stations, including in Nagpur. That stock just does not take a break. There was profit booking yesterday in RVNL, 4.5% down. All those losses wiped out in the first minute or so of trade, up 5% this morning. GMDC has announced that there is an amendment to its power purchase agreement from the Gujarat Regulatory Commission. It's an upside for that stock. Stock is up about 3%. Jefferies is excited about Supreme Industries, has maintained a buy, raised the target price to 6,700. The stock is up 3.5%. So these are some of the winners this morning. Just want to talk a bit about Swan Energy. So it's got the BlackRock Midas touch. From the last few days, pre-open it was up, but you're seeing profit booking creep in the first few minutes of trade. So those are some of the buzzers, but I reckon, Niraj, all eyes on M&M right now. And what's happening there?
Yeah, but I wonder if so there is a bit of a recovery that we're seeing in that stock, because while it started off 6% lower, was about 3% no, but still down about 4.5%. So clearly the stock of the morning. Just before I get to our guest on that, very quickly pointing out if there's something else. No, it is Mahindra & Mahindra is the top loser on the Nifty 500 too, by the way. Chola Holding is up about 7%, so keep an eye out for that. And GMDC about 3.5%. IGL, MGL are up in trade today, and CAMS is up about 6% is CAMS. Really strong move there as well. Mahindra & Mahindra though, the big gash. Mayuresh Joshi, I'll start off with it fundamentally. Is that price cut in SUV big enough for people to be sulking the way they are this morning on M&M?
Not really. I think it will hardly make a difference in terms of the overall earnings, Niraj. And therefore, I think you're seeing a knee-jerk reaction. What you're also seeing is an accentuated reaction, because what you've seen in terms of the news flow, as far as Maruti is concerned, for the concessions that they're probably expected to get, and the expectation in terms of a fillip that they can have if other states replicate this in terms of overall volumes. I think a combination of both these factors is still playing out on M&M. And therefore, I think it's a knee-jerk reaction, in my opinion, very, very frankly. If you probably look at the construct on their Investor Day presentation, they're very, very hopeful in terms of ramping up their entire supply chain to meet the demand in the order book that they probably have at the juncture. At the same time, the farm equipment business, their tractor business with better monsoons, is expected to pick up this year. And if you look at the sum of parts, the other businesses are also doing quite well, including their IT services, their financial services, which are only expected to improve. Obviously, the stock had run up along with the other auto stocks as well. So I think a combination of both these factors is probably leading to some element of profit booking. But I don't see that it's going to create a huge structural change as far as the earnings is concerned.
What else is moving this morning? RVNL 7.5% up. Kalyan Jewellers is perked up 3.5% up. Nykaa is another stock which is moving this morning. Paytm having a good day, 2% up right now. These are some of the movers. Kush, just your take on M&M before we get to what are the stocks that you're spotting right after open?
I'm not too worried about the kind of fall that we've been seeing. I mean, as Mayuresh pointed out, and the stocks actually ran up quite a bit. Some sort of news, not so great, and the stocks actually cracked. But the recovery also has been equally fast. So for my comfort, any kind of dip that comes about, will be a buying opportunity. I still maintain that positional buy on an M&M. So not too worried about the kind of dip. The stock's already approaching the 20-day moving average where it was consolidating for the last 8-10 sessions anyway.
What is the entry level that you see in an M&M?
Well, ideally, 2750 is the level that we're watching for. The day low also for for today, for whatever time the markets have opened, 7 minutes, has been around that time. So 2750 is a good support zone. If it does retrace back to those levels, you should consider starting accumulating this stock. If not, at least don't go into this as a bulk buy, but from a accumulation perspective, it's a good entry point.
2750 if you're looking at M&M. I just want to quickly see what Tata Motors is doing as well, because as Tushar tells me, and this is interesting, Niraj, M&M and Tata Motors are in the EV camp. They have no hybrid exposure. And on the other hand, you have Toyota and Maruti, etc. in the hybrid camp. So it's all going to become about hybrids, or if policy shift shows that the government also wants to push hybrids, so is that a negative for M&M on a more fundamental zone? Becomes the question, doesn't it?
It is possibly the most relevant question, because in the listed space, aside of Maruti, there's pretty much nothing out there on the hybrid side.
Yeah, exactly. And that's what you're seeing. After a 7% run up, you're still seeing Maruti about 1.5% up, because if you want to play this hybrid policy shift, and if you look at it that way, that more states will follow after Uttar Pradesh to incentivize people to buy hybrid vehicles, and the government will have to come in. Who's going to pay 2.5-3 lakhs more to go hybrid unless someone gives you a carrot? So will that be extended is the question. I just also want to come to you, Kush, on what else you're spotting early this morning that can look like an interesting trade.
Well, CAMS was one, but Niraj already took that one away. Also look at an
Where
Alembic
did you
Pharma.
take CAMS, Niraj?
No, no.
He already mentioned it when it was one.
अच्छा आप levels देना ना कब खरीदे CAMS भाई?
No, it's already now shot up quite a bit. Yesterday was a very exciting move. Good to see a follow through on this one. But now I think it's a good idea to perhaps, put a trailing stop loss on this one and, ride the wave rather than enter a fresh with a follow up 7.5-8% move. I think an Alembic Pharma should be on your radar. I know a couple of stocks from the pharma space, but then, that's what's been doing well. The stocks approaching, a 3-year high. So there's a possibility that, it could carry on from there. And look at 150 165 kind of positional levels as well, so keep that one on your radar. A positional stop for Alembic will come close to 120 levels. So from a positional standpoint, Alembic Pharma.
Alembic Pharma, he also Kush also had Torrent Pharma in his wake, so that's something to keep an eye out for. Mayuresh, very quickly before we wrap up, the holding businesses, some of them are making a bit of a comeback again today. Chola is amongst the top gainers there. Do you have a holding company in your portfolio?
No. So again, I think it's all the SEBI news, the circulars surrounding that, and the expectation in terms of how the valuation of these holding companies will probably take place. I think that is what is creating a lot of excitement for all these stocks. You've seen that a few months back as well, but no, not really.
So no holding companies per se, and that's the second best performer, by the way, is Chola Holdings. So 6.5% higher for that one in trade, and then there is of course GMDC, MGL, and the like. So those are the best performing stocks in the session today. Tamanna, not too many losers, or not too many large losers, if you will, say for a Mahindra and Mahindra, which is of course standing out on the BSE 500 yet again. But there are a few others maybe. But the gainers outstrip the number of users by some margin. 261 advances to 225 declines on the Nifty 500. Okay, let's take a break on that note. In fact, thank Kush as well as Mayuresh on the same for joining us today. And let's hear out Mr. B. Thiagarajan. He's in conversation with Samina. The stock was up about 11%. Let's get a sense of what Mr. Thiagarajan has to say.
Retail, which will open up also the food supply chain. And the labor reforms, the government had done enough in the last term, and it is time that we go ahead and implement that. These are my broad takes.
Right. So you talked about competing with China, and we cannot get our eyes off what's happening there, and the fact that there is there is a cost that they seem to be winning over us now and then. In order to boost exports, first give me a sense of how significant is exports for a company like Blue Star? What is your plan? Where do you want to see exports in the next 3 to 5 years? And more importantly, what does the government or policymakers need to do in order to make Indian companies like yourself far more globally competitive?
So the exports of first I will talk about Blue Star, that we have been a player in the Middle East market. We decided to expand our footprint in Europe and Americas. And due to decarbonization initiatives to move away from gas-based heating, air to air or air to water, heat pumps market, you'll be reading about it. Both Europe and US have been looking at how this can be enabled. And the technology for this is available only in the East. It has to be Japan or Korea or China and India. Blue Star has the technology. Because we had to compete with Japanese and Korean players, we invested and developed these capabilities. So our interest is to leverage this in the international market. One, for geographical de-risking. India itself is growing. And other than that, we should have international presence as well. It also gives us an opportunity to learn global standards. This is where we are. Now, it is going to take time. Each country, you have to develop product according to the standards prevailing there in terms of many regulations, refrigerant or energy efficiency. We are on that particular path. Second thing is you are going to compete with China and Korea, who have the advantage of having begun this journey long ago. Two is their domestic scale helps them to compete there. So we have to look at how we can go ahead and bring down the costs. So one.
Back with India Market Open right here on NDTV Profit. Now, energy seems to be a very buzzing sector simply because one, oil prices have inched up a little bit, and two, lots is happening. Remember, there is also a new fund offer underway, which will, once the proceeds are done and the NFO is closed, deploy that capital in the space. And usually these things have a technical impact on specific pockets as well. So let's talk about all of these aspects with somebody who tracks this space very closely, Probal Sen, Senior Research Analyst of India Oil and Gas Sector and Institutional Equities at ICICI Securities. Probal, great having you as always. Thanks for taking the time out. I hope all is well. Just trying to understand, let's break this down and let's talk about upstream first. After a while, we've seen continued positive moves in prices of companies like ONGC. Reliance is nudging new highs. Oil India is doing well. You reckon this is, usually is cyclical by virtue of the oil price moves, but is it as cyclical, or could this be a bit more steady, the prospects of the upstream oil companies?
I think two things have happened. At the end of the day, if you look at upstream companies, there are only two factors that move prices. One is what is happening on the production front, and two, what is happening on the realizations front. So if you really look at the way that the last 6 quarters have played out, both of those things have actually played out positively. ONGC, after a long while, seems to be on track to grow its production meaningfully over the next 2 to 3 years, thanks to the startup of its KG Basin asset. If you look at the guidance that they have been given, they have been giving rather, very clearly, I think 6 to 7% growth, if not more, can be expected thanks to the 30 to 40,000 barrels of oil per day and about 10 to 12 MMSCMD of gas per day that they are talking about producing from this asset for the next 2 to 3 years. And more importantly, in terms of realizations, what the government has done with the kind of windfall tax policy that they have been following is they have ensured that there is a lot less uncertainty about both oil and gas realizations for both Oil India as well as ONGC, in the sense that unless there is a significant bearish run on crude, one can be rest assured that they will be making at least $75 to $76 a barrel. And I think that is very, very significant because it takes away a lot of the volatility that used to be the case in the past. Because one, the crude prices themselves were, a lot more volatile than they have been recently. And two, because there was always some sort of a subsidy or a takeaway or something else, the quantum of which did not used to be known earlier. Now, with the very clear stated policy that anything over $75, $76 goes to the government, anything less than that comes to the companies, and with all indications that crude will likely remain above $80 or $85 in the foreseeable future, this realization is about $18 to $20 higher than what they've earned in the last 7 to 8 years. When you combine this with the fact that production performance actually has been encouraging, both for ONGC and Oil India. Oil India, in fact, the guidance that they have been giving and the production performance over the last 6 quarters suggests that they will probably, show the highest production growth that they've ever done in the next 3 to 4 years on an annualized basis than what they've achieved in the last 10 years. So you put that two together, plus the fact that the gas realizations also are fairly stable now at $6.5 to $7 with additional delta that can come from either premium gas pricing or the new well premium that is being discussed and is being formally, finalized, where new wells drilled and production from those is likely to get a 20% premium on the normal APM gas prices. So, it's just a convergence of factors that just creates a lot more positivity in terms of, how these companies will fare over the next 3 years.
A lot of people talk about how cyclical factors notwithstanding, the multi-year breakouts that are happening, there's this technical factor of this ICICI Pru ETF on, which will also deploy money. They've turned constructive, by the way, because they are not sell side. I'm just saying that we're speaking to their fund manager who said that this time around it seems like the energy needs more. India's energy needs are a lot more trending higher over the course of the next few years, and therefore the business prospects for some of these businesses will continue to be positive. Are you, therefore, Probal, constructive on any of the upstream names? Would you buy an ONGC, Oil India, for that matter, or Reliance Industries?
Yes, absolutely. I think we've had a buy on Oil India and ONGC for a while now, and we see no reason to change that particularly, even after the run-up that's happened in the stocks in the last, let's say, year or so. If you look at where their multiples are still at fairly comfortable levels, given that we do expect consolidated earnings for both companies to, show an accretion steadily over the next 3 years. I would tend to think that there is probably still some steam that is left in these stories. The only caveat here is they will have to continue to deliver production growth. I keep coming back to this, that as an upstream company, the one thing that held them back even more than whatever uncertainties were there as far as realizations or subsidies or other factors are concerned is that fundamentally an upstream company has to deliver production growth. And if there is one thing that has changed in terms of perception and expectations from these two companies, it is that production growth will continue to be fairly strong over the next 3 years. As long as that execution remains on track, I see no reason why these stocks cannot continue to outperform over the next 12 to 18 months.
Prabal, good morning. Tamanna here as well, and great to speak with you today. Now, it's just as a space, the oil and gas sector seems like it's maybe set for a bit of rough weather next couple of quarters. We spoke about upstream. Let's get your sense on downstream. I know you can't speak about some of those companies, but let's give an overview and anything specific that you can add. Are we in for a bumpy Q1 at least, or do you see the pain extending?
No, I think Q1, as you rightly mentioned, is likely to be weak for all the companies who have an oil to chemicals business, including Reliance. There is no doubt that the GRM softness continues to sort of sustain slightly longer than, frankly, what we were looking at. Even in the advent of the US driving season, there hasn't been as much of pickup in product spreads as we would have imagined. So to that extent, you're absolutely right that downstream margins remain a little bit under pressure. The only silver lining here is that, at least from an OMC perspective, the retail fuel margins continue to be slightly higher than historical levels or normalized levels, as they say. They are averaging about 3 rupees for the quarter, but they have ramped back up to around 4.5 rupees. And I'm talking only retail fuel, petrol and diesel on a blended basis. They have ramped back up to around 4.5 rupees plus. So the way to look at it is that on an integrated basis for the full year, the expectation is that they can probably still do about 6.5 rupees a litre on a blended basis, even if full year refining margins, sort of ramp back down to $6.5, $7. I'm building in Singapore benchmarks at, let's say, 4.5 for the full year, which translates to a 6.5 kind of a level for an HPCL, for example. But if marketing margins actually come in and, there's no pressure to sort of reduce retail prices, I still believe that, there may not be too many downgrades to earnings. Having said that, one thing one has to remember is that FY24 was an exceptional year in terms of profitability. Whichever way you slice and dice it, FY25 earnings will be softer on a sequential basis. What needs to be looked at, however, is from a 3-year window, as long as operational metrics continue to improve from a refining complexity perspective and marketing margins get back to normal levels, fuel pricing rather gets back to, business as usual scenario, I think that should sort of support the stock from a longer term. But yeah, the next 3 to 6 months does look like slightly tough period from a margin perspective.
So how does that quantify in your view, Prabal? And, I'll take off from that FY25 relatively is going to be tougher than FY24 for oil marketing companies. You're going to see, softer growth numbers, etc. By how much?
I think if you look at our published estimates, we were building in about 15 to 18% decline in earnings on a consolidated level for HPCL for FY25 versus 24. And that built in a combination of somewhere around $8 to $9 of GRMs, but 2.5 to 3 rupees of margin. What is a likely scenario could be that you could have a $6 to $7 GRM, but a 3 to 3.5 rupees of margins. So at the moment, we would believe that, that's the kind of earnings that one lives with for HPCL, which is very clearly a, mid double-digit decline from the record levels of FY24.
And you can extend it, I suppose, on the same basis to a BPCL as well, because they're sailing in the same boat fundamentally. So, Prabal, would it be fair to say that city gas distribution companies would be the bright spot in this space on relative terms?
I think as far as CGDs is concerned, the one crucial thing is the kind of expectation that is getting now built in that LNG globally is entering an era where there could be a significant oversupply, if not in 25, but starting from CY or rather FY26 and 27. All reports indicate that there's around 170 to 190 million tons of capacity addition that is likely to happen over the next 4 to 5 years against probably an annual demand run rate of around 25 million tons or so, which means that the LNG market may remain in surplus for a fair while. So that is obviously good news for Indian operators, because remember that the supply of nominated gas for the priority segments has been going down significantly, which is having to be met by either premium domestic gas or through LNG sources. So that moderation, I think, is a very, very crucial aspect, in terms of how the margins and price competitiveness can be there. Plus the fact that they have managed to increase their prices right now, at least Gujarat Gas and MGL, means that they are looking to protect and focus on their margins at this point of time. So yes, I think structurally speaking, demand for gas continues to increase, and if margins also stay resilient, I think this sector will continue to do well.
So, Prabal, ahead of the Q1 earnings season, what would you say would be the top buy calls in each of these segments?
Honestly, we don't really give tactical buy calls, to be very honest with you. But if I look at which stock can actually deliver very strong numbers, I would believe that GAIL probably stands out for this quarter. Given the softness in spot LNG and the kind of volume growth that India's gas consumption has seen, our sense is that GAIL can actually deliver fairly strong YOY and QOQ growth numbers for this quarter. And even structurally, if we really look at the factors that I just spoke about, I think GAIL continues to probably be the strongest beneficiary and can see improvements across all segments as far as EBITDA is concerned. So that remains a preferred pick in the space at this point of time.
GAIL is the preferred pick. In terms of RIL, how do you see the pain points panning out for Q1?
Q1, what we are looking at basically is EBITDA going down to about 400 billion against the 420 odd billion that they reported in last quarter. Again, as I said, led primarily by OTC weakness, where we believe that against about, I think, 16,500 crore of EBITDA, this quarter could probably see a decline down to about 13,000 crores. And also, what is interesting is that because the growth that is coming this quarter is primarily from retail and Jio, which are the consumer segments where strategic stake sales have happened, the minority interest as a proportion of overall profits will go up. So net profit will actually see a slightly more higher decline than what your EBITDA would suggest. So to that extent, I think, again, for the first half, OTC might continue to drag down the earnings. But, with the huge ARPU increase that will start to reflect from the second quarter onwards, I think Jio would probably help offset some of the OTC damage in the second half, for the earnings.
So it's all going to be about Jio as far as RIL is concerned. Thank you so much, Prabal, for speaking with us today. Always a pleasure to get your sense. And, we're just putting the spotlight on the oil and gas space ahead of the Q1 numbers. It's going to be a bit of a tough kind of a quarter for both upstream and downstream companies. But city gas distributors could be the shining bright spot. GAIL is the top pick from ICICI Securities. We'll slip into a very short break, but on the other side, we're speaking with the Gokul Das exports. We're talking to them ahead of the budget, their expectations, and what's happening in their space. Stay tuned.
Well, it's a tale of two different vehicles, if you will, or cars running on two different roads, or an SUV versus a hybrid, call it whatever. But look at the difference between Maruti and Mahindra in the session today. And that tells you a story of suddenly the market saying that, hey, has something changed?
Yeah.
Has something changed?
Yeah, I've been thinking of all my, auto puns in the break. One's on a speed breaker, one's on a highway. But that's essentially what you're seeing. Maruti up 3%, M&M down nearly 5%. They're also both the top gainer and loser on the Nifty, respectively, this morning. And the reason that you're seeing that is Maruti is expected to really enjoy the fruits of a shift if it happens on a wider base in policy, which encourages people to buy hybrid cars. And Mahindra right now does not have a hybrid car in its portfolio. The other thing maybe also hitting M&M is the price cuts they've announced. But Niraj, my counter to that would be Tata Motors also announced some price cuts, but has not got badgered like this.
Yeah, and maybe because in M&M's case, it's been an SUV story. It's the SUV piece more than anything else, which has gotten M&M this 80-85% uptick in the last 1 year. If that is potentially seeing pressure, could there be an issue there? So I think it's an important one, but it's just riveting to watch Maruti do what it has done yesterday and today by virtue of this hybrid car piece.
After that continuation as well. All right, another D Street debut, which is on the radar too, actually listing this morning, but we'll talk a bit about Emcure Pharma. You're seeing the pre-open prices also coming in at 1325 versus an issue price of 1008. What's Emcure Pharma all about? Varsha is joining us with more.
Well, thanks, Tamanna, for that. So yes, company has raised almost 1,952 crore through this IPO, which consists of 800 crores from fresh issue. And if you see, about 600 crore will be used to repay the debt, which will actually reduce their interest cost. If you see the business, company is engaged in manufacturing broad range of pharmaceutical products across several therapeutic areas, and company has more than 350 brands, also sells in over 70 countries with strong presence in India, Europe and Canada. Recently company has signed a licensing agreement with Sanofi in cardiology, which will help to grow that segment. The top 3 segments for the company include gynecology, which contributes almost 24%, followed by cardiovascular, which contributes 15.7%, and anti-infectives, which contributes around 11%. If you see the financials for the company in the last 3 years, revenue has grown almost 10%, while FY24 revenue growth was 11%, and profit after tax, if you see in last 3 years, company has grown its PAT of about 6%, but in FY24 PAT was down 6% due to investments done by the company. Also, if you see the valuation based on the IPO price, issue price, the P stands at around 36x, while the industry P is around 40x. So this is all we have on Emcure.
Got it. Okay, Varsha, thanks for putting this into perspective. It's a listing that we'll watch out for 7 minutes from now. But what is also very keen to watch out for, Tamanna, to my mind, is what employee or employment generating sectors will get this budget. Will there be a focus on textiles, on some other sectors which can do this? Tourism. Yeah. And what can happen thereof. So I think it's an important one to watch and therefore discuss as well.
Yeah, absolutely. And right on cue, we have Sivarama Krishnan Ganapati joining us, Managing Director at Gokuldas Exports. Very good morning to you, sir. And thank you so much. Pleasure to have you today on NDTV Profit. And we're speaking...
Pleasure to be there.
Absolutely. We're speaking to you just a few days out before the first budget of Modi 3.0. And so let's start with that sort of context setting. And what my colleague Niraj mentioned as well. The focus is going to be on labor-intensive, employment-generating sectors. Textiles has been in focus. Let's start with what you hope to see from this budget.
Well, from our perspective, there is continuity in policy. That's great. We are. I think government has done a lot. And when I say government, I mean both the central and the state governments. And there are several state governments which are actually actively encouraging more labor-oriented industry and supporting, further capital creation there. I think, we have what is called ROSCTL. If there is continuity of that, I think that's what we are looking at, and a long-term visibility of that. So those kind of signals are more than sufficient for the sector to continue to perform well.
Okay, so that's the big budget expectations. Now let's talk about what's happening in terms of market dynamics right now, Mr. Ganapathy. The industry overall is facing an issue of an inventory overstock. How are you at Gokuldas dealing with this?
So this inventory overstock is with the retailers, especially the Western retailers. And most of those retailers have more or less worked their inventory out. So if you look at the fashion retailers, by end of 2023, most of them have reduced their inventory to 2022 levels or even earlier. And most of the other wholesale kind of retail entities, sportswear and other companies have also reduced their inventory levels considerably. So now we are seeing a fairly good demand traction from the retail industry from the West, both US and Europe. The retail demand, which is the end user demand, continues to be doing good at about 2 to 3% year-on-year growth. So that is encouraging. And with the inventory levels coming down to near normalcy, I think increasingly going forward over the next 6 months, we will start seeing demand picking up.
Just to follow up on that retail demand, are you seeing it across the board? Are you seeing differential in terms of tier 1, tier 2 cities? And are you seeing export demand also panning out on that sense?
So I was really referring to export demand because we are almost exclusively in exports, and we cater to both US and Europe. And both of these regions, we have seen fairly secular retail demand growth. As far as India is concerned, I am aware that there is a little bit of a demand softness, but then that's not a market we really cater to. So we're not really tied into that market at all at the moment.
Okay. Sir, good morning. Just one question. I know we can't talk about specifics. So we'll do that after your numbers are out because you won't be able to talk numbers, etc. But your whole strategy of backward integration and those OCD investments that you did in order to do that as well into yet another asset. I'm just trying to understand, do you reckon that if the focus in the budget is on textiles and some export impetus being given, does that increase the probability of very high growth over the next 3 years for you as a company?
I think so. So we will, the industry or the sector itself, if there is a right impetus from the government as well as the right environmental structure which exists, in my belief, that is fairly good demand traction from the global customers. I think if these two coexist together, I think for the next 3 years we will see a fairly good growth for the sector.
Got it. Mr. Ganapathy, we look forward to talking to you post your quarterly numbers are out so that you are in a bit less constrained, let me put it that way, in talking about numbers. Wish you all the best for the quarterly numbers and look forward to talk to you post that.
Thank you so much. Really appreciate it.
Not at all. The pleasure is ours to have you to just get this brief sense about what could happen in textiles. Remember, a lot of brokerages are saying that watch out for sectors like textiles. That is where key impetus will be given in order to generate employment as well, create jobs too. Let's see if it's good for these stocks. By the way, what is good for stocks is the market today for the new listings at least, because both of them seem like they'll start off on a good footing. We're about to see both of those getting listed, and it's a heady moment for promoters associated with companies to see the listings because, I mean, really, it's a big thing. So Bansal Wires at the BSC, Emcure Pharmaceuticals at the NSC, and both of them, based on the discovered price, have actually had a very, or possibly will have a very decent start on open. And what a moment, Tamanna, for companies which are getting listed and listing at a premium.
Absolutely. And it's talking about a healthy market. This is going to be the year of the IPOs, by the way. And let's listen in to that countdown.
3, 2, 1.
Well, let's get the listing prices up on the screen for both of these. Can we just have the prices? 40% for Bansal Wire, 32% or 33% for Emcure, and both of them got subscribed over 59 times. I think one was 59, one was 67 times.
Yeah,
and it's showing.
Both are interesting companies. Emcure definitely engaged in developing, manufacturing a broad range of pharmaceutical products across several therapeutic areas. It has more than 350 brands. It sells in over 70 countries with strong presence in India, Europe, and Canada. That stock up 35%. So 1,008 was the issue price. It's a good day of profits for Emcure Pharma, for Bansal Wire as well. So both of them coming in with good news for their investors. But like I was saying, Niraj, this is the year of the listings. Whether it's a Hyundai, Ola, I mean, you have all the biggies also making a beeline for the Indian market. So it's going to be a good one.
Yes, maybe today in the afternoon, there is a beautiful note as we wrap up this show from Axis AMC on the quantum of supply that has come in thus far and the quantum of supply that is slated to hit our markets. Primary issuances, secondary capital, and lock-ins opening up, and those shares coming for sale. FY25 is going to be a heady year for supplies. I think we'll try and talk about that a bit later on the channel.
Absolutely. But for now, we'll take a very short break because we're wrapping up India Markets Open. Up next is Talking Point. Stay tuned to NDTV Profit.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat for our guest, who is Mihir Vora, CIO of Trust Mutual Fund, is whether earnings will live up to the kind of valuations that we are trading at, and whether we can actually bump up higher from there. So that's the first point, of course, you've got to keep in mind for whether Q1 results can deliver the positive surprise. Talk a bit about power and the whole argument about renewables versus thermal. Is it renewables versus thermal, or is it renewables and thermal? Will capex pick up in H2, and therefore will private capex need to put up its hand, or will government capex be enough? I think all of these questions could well determine what the markets do in the times to come, and it's an absolute delight to have it Mihir Vora, CIO of Trust Mutual Fund, to talk about all of this and more. Mihir, great having you. Thanks for taking the time out. I hope all is well. A lot of people, Mihir, are a bit circumspect about the valuations that we are trading at, especially since it's an event-heavy month with both earnings, which is probably a seasonally weak quarter, as well as the budget lined up. What is your view on the markets currently?
Hi, good morning, Niraj. Thanks for having me. The markets are where they are, in the sense, if you look at, say, large cap valuations, they are still reasonable. I don't see any concern there. Then there are pockets of valuations, and especially the low floating stock category, the small and mid caps, where there is a bit of a froth built up, and I would be very careful on those sides. So I think there is enough, I would say, juice left in the market as far as stock picking potential is concerned. But obviously the opportunities are less than what they were, say, 1 year ago or 2 years ago. So I think the core philosophy should not be forgotten, and we need to continue to focus on earnings growth, stocks where we see visibility of earnings growth, where valuations are still, relatively speaking, reasonable. And most importantly, do not go down the speculation path, and do not go down the quality curve, in the sense we have certain, as an investor, certain benchmarks for quality of the stock, of governance, of the financials, etc. Just because something is optically cheap doesn't, relatively cheap compared to the other stocks which have gone up a lot, does not mean we chase the next cheap stock. So I think not compromising on quality, sticking to the basic fundamentals. If you do that, there is still scope for stock picking in the market. As I said, there is a bit of froth in the small cap space, in the SME space, in the mid cap space. But overall, I would say large cap valuations are still reasonable, and we can pick and choose and build a portfolio.
Okay, Mihir, the question that comes to mind is some of the texture of this market, right? Globally, we've seen so many voices talk about how the US markets are expensive and the market is marching on to its own tune. Calling out tops has become so difficult. Is it, you of course look at long-term investing, but I'm just trying to understand, because you have a tactical mind too. Is it prudent to wait for the market to show its hand on the downside instead of taking a large cash call, even for a tactical trader?
Certainly, because the last 3 years have, if anything, they have proven is that it's wrong to take a big call on the market on the either side. So there's no point in panicking and selling if there's a sharp correction, and vice versa. There is no point in chasing when the markets are in a frenzy. So I think sticking to the middle path and taking prudent calls is more important. So we all know the markets are at new highs. So obviously you don't want to do lump sum investments at this point in time. And if you are fully invested, then obviously there's no harm in being a little more conservative and putting a little less money than before into the markets. If you're absolutely underexposed to the market, then obviously you can think of a regular or a staggered investment plan. But I think sticking to the middle path is the best thing to do, not take extreme calls.
Okay. So in a scenario like this with earning, based on whatever you estimate the earnings to be as well, Mihir, and earnings not just for quarter one, for the quarters ahead, but Q1 might just well give an idea of what could happen. Where is it that you are either constructive on at these valuations? Where is it that you are certainly away or completely bearish on, if not bearish, not bullish on when it comes to specific pockets?
Sure. So if I look at the growth versus valuation equation, a couple of sectors do stand out. One is financials, banks as well as NBFCs, where I think the underperformance has been there for quite some time. And for valid reasons, of course, there are margin pressures, liquidity has been tight. So even this quarter, you may see single-digit earnings growth on the PAT for the banks because the cleanup has happened, write-backs have happened, so clean balance sheet. But there is a little bit of question in the short term as far as the margins are concerned. But having said that, the underperformance has been there for quite some time, and relatively speaking, this looks one of the most attractive sectors. I think a lot of people are underweight on the banking sector, so this sector does offer a pocket of relative value as far as growth and the balance of valuations is concerned. Because see, if the call is that India is going to grow at 7 to 8% in the next few years, then credit will grow at 14-15%, and credit has to be supported by deposit growth. So this tight liquidity situation is not going to last forever. Good thing is that we are seeing at least initial signs of the Fed, sounding a little more dovish than before. So this extreme tightness that we are seeing in the global situation, the winding down of the balance sheet, should kind of alleviate in the medium term. So banking and finance overall looks fine. I think the physical asset creation story still continues. Within that, of course, there are pockets where we have seen a lot of action. For example, capital goods stocks, especially mid and small caps, have run up quite a lot. So the attractiveness is to that extent a little less than before. But construction companies are still available cheap, and they have not gone up to that extent. And again, if you're going to create that physical infrastructure, you need construction companies to do well. So I think there are pockets, for example, like pharmaceutical stocks. They have done well, but again, given the growth potential, there can be some pockets of value there. So I think there is enough, sub pockets in the market where we are comfortable in, and that's where we would like to focus our attention on.
Yeah, and farmers had a heady move the last 2, 3 days or 4 days. Value plus expectations of good earnings. But Mir, you made an important point about if India is to grow at a particular point of rate, then what could do well. The same breadth, people talk about how if India is to grow at 6, 7, 8%, power as a sector has to deliver. Power capacities have to get built out, supply of power needs to happen, generation will pick up, etc. And it's a big theme, expectations a lot about what could happen in the budget as well for the sector too. How do you think about this whole piece, thermal versus renewable, ancillaries within that, financiers and the valuations that each of these might be trading at? And what kind of exposures do you guys at Trust MF have within the power ecosystem?
So I think to answer your first question, it's everything and. We are short of everything. We are short of transmission, we are short of distribution, we are short of generation, smart metering, everything, renewables, conventional, everything. I think we are short of, and the sooner we ramp up our power capacities, the better. China is approving 100 to 200 gigawatts a year of power capacity. I mean, it just boggles the mind where we stand in comparison to what China is building out there. So, the kind of catch-up that we need to do and the kind of potential that is there for manufacturing and infrastructure creation requires so much power. And now this whole data center upside is something that we've not even factored in, say, 5 years ago. So to that extent, whatever we build will be consumed. There is a perennial shortage of power, I would say. So it's really a long-term story. So we are bullish on all aspects, frankly speaking, transmission, generation, distribution, and industrials in general is our biggest overweight in the portfolio, and that's because of all these factors.
Got it. And you believe, so in some people's argument that, let's say, some of the equipment suppliers, some of the power financiers, some of the other ancillaries, cable companies, etc., the argument people make is that they've run up a lot already. But if you, in your wisdom, are looking at a multi-year theme, has the run-up been so swift that it makes you uncomfortable? Or do you think that valuations are still palatable?
There is some discomfort at the pace of rise of the stocks. Especially, driven by the fact that there have been so many
I would say, thematic funds and the sector-specific funds which have come up, which are driving these stocks up. So, and this includes not only the power sector, but the whole manufacturing, infrastructure, including defense and all that theme. We've seen so many, mutual fund specific, thematic funds, as well as in the PMSCI space. So there is a bit of a frenzy out there, and I would be a little cautious and be more choosy than before, for sure.
Okay. Point noted. Mihir, stay on. So much more to talk about. I'd love to talk about today's key developments as well, and that would include autos, because autos are so much in news. It'd be lovely to get Mihir's view on the same. Take a quick break, viewers, and come back with more on Talking Point today. Stay tuned.